Hi, everyone, and welcome to the second show of the podcast. I am very, very thrilled to have a true legend of the value investing world with us today, Whitney Tilson. Whitney Tilson really needs no introduction whatsoever. He is the founder of Empire Financial Research and Case Learning, and formerly the hedge fund Kase Capital. Whitney has appeared on CNBC, the Wall Street Journal, 60 Minutes, you name whichever journalistic channel that you want to name. Whitney has some amazing insights to share with us, not just in the investing space, but he has such powerful lessons and insights on how to live a good life and how to find true hobbies and passions. And today, in the course of this conversation, we're going to discuss with Whitney about his time running his hedge fund Case Capital, his early start in the investing business, his newsletter, his investment newsletter today, his interest in education reform, and the many outdoor passions that he has. So, Whitney, welcome to the show, and it is a true privilege and honor to have you as a guest today.
Thank you. It's my pleasure. Always enjoy talking to young, entrepreneurial, value-oriented investor types. Good to meet you.
Thank you so much, Whitney. You've made this really hard for me because you've done some amazing things in your life and you've had an amazing life story. And I kind of wanted to start all the way in the beginning in your early childhood. Your early childhood is so fascinating. You spent 3 years in Tanzania, 3 years in Nicaragua, and I wonder what those unique experiences, what impression those unique experiences had on you personally, and how have they shaped the person you are today? Starting off with a very broad question, but I just thought those childhood experiences were so interesting.
Yeah, my parents met married in the Peace Corps, according to family lore. They think they were the third couple to meet and marry in the Peace Corps in 1962. Excuse me, have to sneeze. No, excuse me. Um, and So they were the third couple to meet and marry in the Peace Corps, served in the Philippines for 2 years. Interestingly, my mom's a year older than my dad. She had just graduated from the University of Washington in Seattle. Her father was a Seattle fireman, a classic middle America, 1940s, 1950s, blue collar, middle class. My mom and her three siblings all went to public school, all went to University of Washington, and all went on to have successful lives. Where one guy with a union job could support a family. My dad was almost the opposite. On the opposite coast, grew up in New Haven. His father and grandfather were prominent lawyers and politicians in Connecticut, and whereas my mom never set foot in a public school, private school in her life, my dad never set foot in a public school in his life. Went all the way through private school through Yale, and actually was sort of struggling at Yale, and Yale didn't kick out the children of prominent people, certainly not back in 1962. And so they suggested that he take some time off. And so he was like, oh, what do I do? I've sort of been kicked out of college here. And the John F. Kennedy's call for the Peace Corps inspired him, just as it did my mother. They met during Peace Corps training in Hawaii, were part of the same Peace Corps class, but they were going to be sent to different islands and had to suddenly get married. Otherwise, they would have never seen each other again, probably. And so at the age of 20 and 21, they got married in Manila, and have spent most of their careers, all of their careers, in education, most of it in developing countries, on U.S. government funded educational projects. So that was the initial age 2 to 5. I was born in Yale New Haven Hospital, just like my father and grandfather. But at age 2, we moved to Morogoro, Tanzania, where my father was training teachers at the Morogoro Teachers College. And then 3 years out at Stanford, where my father was working toward his doctorate in education there. And one of my sole claims to fame is I was one of the marshmallow kids that they tested back in 1972 at age 6. Would I or would I not eat the marshmallow that they were tempting me with? One of the most famous social science experiments in history. And then went down to Nicaragua for 3 years, ages 8 to 11, came back. My dad finished his doctorate, and lived in Western Massachusetts for 8 years. My parents sort of settled down. My dad took a job as dean of faculty at the largest, at the time, private boarding school in the country, Northfield Mount Hermon School, about 2 hours west of Boston in the Berkshires in Western Massachusetts. Sort of an idyllic childhood there, not quite the adventure of moving a lot and living in foreign countries. And my sister and I finished high school there. I went off to Harvard 2 years later. She went off to Stanford. And then my parents soon thereafter moved back overseas to Ethiopia for 8 years. And they've been in Kenya now for more than 25 years, where they've retired. So I grew up, the impact of growing up in developing countries like that. Um, One, we were a very tight family. We just had each other, and that was wonderful. I got to see more of the world by the time I was 5 years old than most people see in their lifetime. So it was a very broadening, enriching experience. It definitely implanted the do-gooder gene in me, seeing the incredible wealth. We were very middle class, but incredibly wealthy relative to the people we were surrounded by in Tanzania and Nicaragua. For sure, gave me an appreciation and gratitude for all the gifts and good fortune I've had. And one of the major pillars of my life, the three pillars of my life, which are my family, my work, and my philanthropy, that third pillar came from that experience living overseas. So just to finish the life story, graduated high school, got into Harvard, spent 4 years there, helped start Teach for America, and worked a couple years at Boston Consulting Group, went back to Harvard Business School, met and married my wife during that period. Our 30th anniversary is coming up in a few months, and we've got 3 adult daughters in their 20s, only one left in college, but we became empty nesters a year ago. And so I moved down to New York after I finished business school because my wife was from New York, and spent a few years doing a nonprofit that I had started while at Harvard Business School with Professor Michael Porter, called the Initiative for a Competitive Intercity. And then in the late 90s was a late 90s bull market genius and started my own hedge fund out of my bedroom with $1 million under management, built it up to over $200 million over a dozen years, and then completely misread this long bull market starting after the global financial crisis, and underperformed the market after 12 years of outperforming the market by a wide margin, underperformed the market as I was playing defense during a bull market. And in frustration, closed my fund 5 years ago and got into the investment newsletter business, where I can still play the game I love to play as an investor. I can still help people make good financial decisions and avoid all the traps out there, but I don't actually have the pressure of managing other people's money, which was a huge weight off my shoulders. So, here I am today, counting my blessings, in good health at age 56, and the things at this age that I see, really bringing a lot of other people down, mainly relationship issues, most notably divorces, midlife divorces, and health issues. Knock on wood, I've been lucky to avoid so far, and I'm trying my darndest to keep avoiding those things.
Thank you so much for sharing that life story, Whitney. That was really good. Uh, I believe you grew up in Massachusetts, right? After you came back from Tanzania and Nicaragua. I wonder, before you went off to college, what were your interests in high school? And did you know at that point what you wanted to do? And where did your interest in business initially spark?
Yeah, it wasn't in high school. It was when I got to Harvard. They had a student-run collection of businesses under the umbrella called Harvard Student Agencies. And I stumbled into a job, believe it or not, with Bill Ackman. A guy hired the two of us to sell advertising in the Let's Go travel guides. And back in the days before the internet, when Americans would go to Europe, American college students, they carried the Bible of the budget traveler, a big orange book called Let's Go Europe, and it was written by Harvard students the previous summer, and so there would be a whole army, a dozen or 2 dozen Harvard students as a summer job would go travel through Europe and stay in youth hostels and write up and update last year's travel guide with the freshest, best information about the best youth hostel to stay at, how to travel on a budget, what was the best bar to go visit, what were the most fun things to do. And so it had an incredible readership. And so Bill and my job was to sell the advertising in those guides. And that was what really sparked my interest in business. It was a major operation. These books were published all over the world, and there was a whole series of them. Let's Go Europe was the flagship publication, but there were like 10 of them. And partly it was, I grew up, I remember in high school, I won an award from the high school that came with a $100 prize. And I remember winning, it was called the Headmaster's Award, and the headmaster at his discretion gave it to the students he thought, had contributed the most to the community, and et cetera. And I was so stupid and so shallow and so poor that the $100 in the envelope was what I really cared about, not this tremendous honor that had just been bestowed on me. So Bill and I were such good salesmen, you won't be surprised to hear, that each of us sold as much advertising as the previous three-person team the summer before. So what had happened is that the manager of the sales department hired two of us, and they had always had three. And Bill and I persuaded him correctly that, hey, you don't need a third person. Let's split the pie two ways, not three ways. And sure enough, we both blew doors out. And we each, so the idea had been the previous three guys had made $15,000 of commission, maybe 12,000, split three ways. So our expected comp was about $4,000 for the summer, let's say. And Bill and I each made like 13 to 15 grand. And we just blew the comp structure. They had to completely restructure it, but for the first time in my life, I had some money. I was thrilled. And I then had two horrific realizations because I was stupid enough to tell my dad about this. Number one, he said, well, you have to pay taxes. And I said, what do you mean? I'm a student. I'm a poor, starving student. He's like, the IRS doesn't care. You just made enough money. You got to file a tax return. And I remember sending a check off to the government for, I don't know, a couple $1,000s, which is by itself a huge fortune. And I still remember the shock and horror of realizing that as an impoverished student, I owed taxes. Then it got worse. Then I went to register for classes next semester. And of course, I always was, I had to figure out how to raise the money. And usually my parents sent the money or borrowed. I borrowed or they borrowed the money. And my dad's like, congratulations, you can just pay for next semester. So all of my money, Bill ended up buying a pair of super high-end speakers. He comes from a wealthier family that was paying his way through college. He wasn't taking out loans and wasn't expected to be paying things out of his own pocket. And meanwhile, so my entire 10 or 12 of the 12,000, let's call it $12,000 I made, 2,000 went to the government and 10,000 went to Harvard, and I had nothing left. But I will tell you, working at Harvard Student Agencies that summer, and then the next year, I ran another one of their little businesses that would type up papers for students. It was called text processing. This is back in the day when students didn't have computers. So if they could either handwrite their papers and final exams or what have you, their take-home finals, or they could pay us, and we hired student typists or whatever. But it gave me my first taste of the business world. And keep in mind, my parents were both teachers. I didn't know what a stock was. I knew nothing about business. And I got some great exposure over a couple years. And then later in college, I did 2 summers running a franchise of college pro painters, which was basically, I think they claimed at the time to be North America's largest house painting business. And it was run through franchises of college students like me who would in turn hire an army of other college students to go out and paint a lot of houses. And so I painted something like 75 houses in 2 summers with a team of 30 people that I hired after my junior and senior years at Harvard. My freshman year was Let's Go with Bill Ackman. My sophomore year was running text processing. And so I made a lot of mistakes. I was not a great business person, but I ran a big operation. I was a great salesman. I was not a good people manager and didn't control costs very well. And so I didn't make nearly as much money as I should have, but it was an incredible formative experience. And I think really helped me get into Harvard Business School because look, so many people applying to Harvard went to an Ivy League school and did 2 years at Boston Consulting Group. What really differentiated me was that I had some real entrepreneurial experience running a business that had done, I don't know, $100,000 of revenue and had 30 employees. Not many people applying to HBS had that story. And then on top of it, I spent 6 months helping Wendy Kopp start Teach for America, which again was really differentiated me from the average iBanker consultant applying to HBS. So that was it was really in college, not high school, that really piqued my interest in business. I'd say early on in college, I knew I wanted to go to Harvard Business School. One of my friends invited me over to sit in on a class, and I still remember to this day the case study. It was called Consumers Distributors, and it was like a Walmart kind of retail business that was known for super low prices. And it turns out, because my family is the cheapest people on earth, my mom's been clipping coupons for 80 years, is we had shopped there many times. And so I sat there in the class and I literally had to sit on my hands and bite my tongue because I knew this company and no one else in the room apparently had ever set foot in one of these stores. So I wanted to raise my hand and nail the case. And I couldn't, of course, because 50% of your grade at Harvard Business School, at least at the time, was class participation. So airtime is a very precious commodity. So some college student, guest is not allowed to speak. And I knew that, so I couldn't speak. But I was sitting there like, man, I love learning this way, right? With a real world case study where, I nailed it. I knew the answer. And so from that point on, I knew it was the only business school I applied to. Had I not gotten in, I just would have continued working at BCG for another year. So it was those experiences that really got me interested in business. But keep in mind, even at that point, I knew absolutely nothing about the stock market, investing. I had never owned a stock in my life. My parents had never owned a stock in their lives. That came later.
Thank you so much for sharing that. I did want to ask you, can you share your experiences running your nonprofit after HBS, and what gave you the courage right out of a very prestigious MBA program to sort of take the road less traveled compared to your peers?
Yeah, well, I still remember when I got a letter. Again, this was pre-email, pre-internet. I got a letter in my mailbox, and it was always every student had a little cubby with where we would get little flyers every day about things that were going on. Come here, XYZ speaker. And there was a letter from Michael Porter, who I had not known, but I knew him by reputation, this absolutely legendary HBS professor. And this was right after the Rodney King beating, followed by the LA riots. And so there was a lot of attention being paid to America's inner cities and the many problems that ail them. And the flyer said, I'm looking to hire a group of students for this summer and next school year. So it's a 1-year commitment. This was spring of my first year at HBS. And I had sort of assumed I would just go back and work at BCG over the summer. But then this came up, and I remember it just struck me, wow. The opportunity to work with one of HBS's most famous and brilliant professor to address one of America's biggest social issues, that really hit me. And so I applied and was one of 5 students that he picked. And ultimately, we ended up doing research out in the field, out in Roxbury and Dorchester and Boston's inner city communities, that led him, Michael Porter, to publish a paper called The Competitive Advantage of the Inner City that got a lot of national attention. And long story short, I ended up agreeing not to go back to BCG, which would have paid my way through business school. So instead, I graduated with a bunch of debt. And was working with Michael Porter at, I think, a salary of $75,000 a year. This was back in 1994. I was at that point married. My wife was working as a lawyer, earning double that. She had just graduated from Harvard Law School a year ahead of me. And we lived in her grandparents' apartment on the Upper East Side. They had moved down to Florida. So we had white privilege slash family rent control working for us. So our costs were low. We didn't have kids. For our first child didn't arrive till 1996, a couple years later. So we lived modestly, saved money, paid off my business school debt, and it was only, I would say, maybe 1996 that we were finally debt free. And then because we were both earning, I was earning a modest salary, she was earning a nice salary, and our expenses were virtually nil. We saved money to pay off my business school debt. My wife's family had paid for her law school, so she didn't have debt. And we had $10,000 in our checking account. Was the end result of living beneath your means for an extended period. And I remember at that time, the stock market was ripping. We were in a long bull market, and I called up Bill and my college buddy, who I'd kept in touch with, and he, having graduated Harvard Business School in 1992, had started one of the first hedge funds way back in the day when there was sort of Julian Robertson and George Soros and Michael Steinhardt. And that was about it. Like the hedge fund world wasn't even 1% of what it was today. Nobody from Harvard Business School back in Bill's class of 92 or my class of 94, like you can count on two fingers the number of people who went into hedge funds back in the day. And but Bill was one of them, had always had an interest in investing. And so I called him up and I said, "Hey, Bill, I've got some savings. What should I do?" And he said, "Go read all of Warren Buffett's annual letters and you can stop there. That's all you need to know." And by the way, this coming Friday, I am going to Omaha for my 26th consecutive Berkshire Hathaway annual meeting. So Bill introduced me to who Warren Buffett was. I had vaguely heard the name, but had never studied the stock. At this point, I'd still never owned stock in my life. And Bill turned me on to Warren Buffett, and over many, many, many years, continuing to this day, I've just been passionate about investing, particularly value investing, Warren Buffett style of investing. Try and buy high quality dollar bills for 50 cents. And all the other things. It's really like a cult or a church. I call it the Church of Graham, Dodd, Buffett, and Munger, that I discovered and became a passionate disciple. And I would say one of the senior people spreading the gospel of Buffett and Munger over the years. I was one of the authors of this book, Poor Charlie's Almanac, which I highly recommend. Which is the sort of the definitive book on Charlie Munger. And I used to be the guy before they recorded and live streamed the annual meeting of both Berkshire and Wesco, which was Munger's meeting. I was the guy who would go there and take notes until my wrist ached for hours after hours, and then I would type them all up and produce sort of the definitive notes from the meeting.
Uh-huh.
So I'm wandering, probably answering some of your questions in advance of you asking them, but
Yeah.
yeah,
Given that you never owned a stock in your life until you
yeah.
turned 30, how did you learn? What were those early days like? Was it you just with Bill's advice, take all of Warren Buffett's annual reports and read them? Was it you locked inside a room doing that, reading a finance textbook, an accounting textbook, or what did those early days really look like? I don't think it was that. I think you started your hedge fund immediately. So I'll be grateful if you could share that experience.
Yeah, well, actually, there was sort of a 3-year gap. My best recollection is probably somewhere around 96 that I talked to Bill and he turned me on to Buffett. I didn't start my hedge fund till January 1st of 99, so it was 2 to 3 years later. And in those intervening 2 years, basically, I was a jackass. I went out and I bought stocks based on hot stock tips, and total frauds I got sucked into. But at the same time, I was like, I did, at least with most of my portfolio, sort of buy blue chip stocks and high quality businesses and all. but I wasn't really a value investor. Like I was buying Dell and AOL and Microsoft and Intel, which were great businesses, but they had gotten caught up in the early tech slash internet bubble. But I got in early enough that I was making a ton of money, and I still remember a transformative event. I took my wife's. She had saved up 20,000 bucks in her 401k or IRA, and I was an early disciple of the Motley Fool website and was reading their stuff. And people my age may remember back then they were pumping AOL and iOmega were the two stocks they were pumping like crazy. And I fortunately avoided iOmega, but got into AOL in 1998, early 98, or maybe late 97. And AOL, that $20,000, AOL caught the internet bubble, took off. AOL was right at the forefront of it, and it went up 6x in 1 year. And so my 20,000 turned into 120,000. So I just made $100,000. And again, my annual salary pre-tax was 75 grand. I had just a year or two earlier thought I was rich because I had no debt and had $10,000 in my checking account. And I just made 100 grand in a year, doing nothing other than buying something that seemed very obvious to me. It was a website that I used regularly, and I was following it every day on the Motley Fool, and so forth. But here's the crazy thing: I didn't ride it all the way back down. I went and met with Bill and told him I was thinking of starting my own fund, and he's like, "Well, what does your portfolio look like?" And I showed him my two biggest positions were AOL and Dell, and look at my incredible performance. And he's like, Whitney, we're in a bubble here. These aren't value stocks. You're going to get blown up. Buffett would never own these stocks. And I had the good sense actually to listen to him. So I sold that $120,000 of AOL stock, and I bought 2 shares of Berkshire at 60,000. And I didn't sell all my tech stocks, but I had decided that I was God's gift to investing because look at my portfolio. My AOL went up 6%, 6x. My Dell had doubled. My Microsoft doubled. My Intel doubled. I was God's gift to investing. And so, filled with the hubris that comes from making a lot of money, I was outperforming this brilliant friend of mine, Bill, for sure. He was doing fine, but he didn't own any of these silly tech stocks. And so I decided to hang out my shingle as a hedge fund manager, having not worked a day in the industry. And in hindsight, it was a rash and reckless and arrogant thing to do. I had absolutely no business starting a fund, had none of the requisite experience. I should have persuaded Bill to hire me and gone and learned from somebody. That's the proper way to start any business. But, when you graduate with high honors from Harvard, and then you graduate with high honors from Harvard Business School, and then you go out and you start picking stocks and they all go up a lot and all, it just sort of goes to your head. And you don't stop to think that maybe there's just a lot of luck here and you have absolutely no business managing anyone else's money, much less starting your own business in a sector that you know nothing about. By all rights, I should have blown up when the internet bubble blew up. But thank goodness I listened to Buffett, started going out to the Berkshire meeting back in the late 90s. I listened to Bill, and I listened to Joel Greenblatt, the legendary special situations value investor, who was teaching a class up at Columbia Business School. And just like Warren Buffett, who would go back in the day and sit in Ben Graham's class, in the back of the class, I don't remember. I'm trying to remember. Was he actually a student of Ben Graham's, or did he, because Ben Graham, I know, would allow people from Wall Street back in the 1930s to come sit in on his class and sort of audit the class. I forget whether Buffett may have been a legitimate student, but I was not.
Buffett was a student. So Buffett was rejected from HBS,
Right.
and after he was rejected, he figured out that this guy that when he was at the University of Nebraska, the book that he read by Ben Graham when he was 19, he
Sure.
figured, this guy actually, he remembered that he teaches in Columbia. So
Right.
he wrote him a letter saying, I thought that you were dead, but now that I've figured out that you're alive, does Columbia still have a spot? And he
Right.
was like, yeah. So he applied and he got in.
Yeah,
So
yeah,
that's why I think Buffett said that the HBS rejection turned out to be one of the best things in his life.
it's true. It's true. I went and sat in the spring of 2000 at the very time that the internet bubble, one of the greatest bubbles of all time, peaked on March 10th of 2000. Let's see, this would have been 19. No, this would have been the year 2000. So the Nasdaq was up 86% in 1999, but it continued into the first 10 weeks of 2000, peaked on March 10th. I remember that day well because I sold a bunch of my tech stocks that day and bought 6 shares of Berkshire Hathaway the day it bottomed. Friday, March 10th was the day the Nasdaq peaked, was the day Berkshire Hathaway hit a multi-year low at $40,600 a share. And I put 30% of my little, $4 million fund into Berkshire at that time. I'd been buying it all the way down, and I just couldn't. I'd started buying in the 60s, and then I bought it at 60, bought it at 55, bought it at 50, and it kept going down and down. And there's just, as people were pulling money out of their value-oriented mutual funds, and hedge funds, the managers of those funds were being forced to liquidate. So there was just forced selling, and everybody was piling into tech stocks. And so Berkshire almost got cut in half. And I loaded up, and within 2 months, the stock was up 50%. So I had a 30 odd percent position up 50%. So I wouldn't suggest, and this was 15 months into the new fund that I had started with $1 million back on January 1st of 99. I built it up to 4 million by the end of the first year, mostly by just tapping my HBS network of friends, Bill's dad, 5 or 10 of my Harvard Business School section mates and classmates invested. Then, I was still owning tech stocks in 99, so my portfolio did really well. But I was proclaiming myself to be a value guy and buying Berkshire. But I was hanging on to my tech stocks, hoping to get, one last squeeze of the lemon there, and I did. And then, I didn't get out on the very day it peaked and all, but basically over the course of a year, I was exiting the overvalued tech stocks and getting into Berkshire and value stocks. So when the market did puke out, I had fortunately, in the nick of time, gotten out of the way of what became an 80% decline in the NASDAQ from the peak in March of 2000 to the bottom on October 9th of 2002. 80% peak to trough. Stock like Amazon went from 400 to 5. This was multiple splits ago. Priceline went to $1. Later went to $2,000. Right. So I played it. I played it reasonably well. It was a combination of being lucky, but also, cultivating the right mentors and going and sitting in on Joel Greenblatt's class and going to Omaha every year, reading everything Warren Buffett and Charlie Munger had ever said or written. I had recordings. Again, this is back pre-internet days, so everything wasn't on the internet. I found all of Buffett's partnership letters going back to the 1950s. Nobody else had assembled them. When Alice Schroeder went to write her book Snowball about Buffett, and she asked Buffett as part of her due diligence for the book, she told me this story later. She said, Warren, can you just give me a copy of your old Buffett partnership letters? And he said, I'm not sure I have a complete copy, but go ask Whitney. He has the most complete copy. He has a more complete copy than I do. And it was true. When they came to write this book, Poor Charlie's Almanac, a guy named Peter Kaufman was the lead guy on this. They invited me to be one of the contributors to the book. I wrote chapter 3, etc. But the book is centered around 10 of Munger's famous speeches, like the 24 causes of human misjudgment is the title of one of those speeches, a famous one. Well, it turns out I had the recordings and had made the transcript literally myself. I had sat down and typed up the first transcript ever of 5 of Munger's 10 most famous speeches that nobody else had. So naturally, when Peter Kaufman went to do the book, he called me up and said, "Hey, can you provide the transcripts? And by the way, will you edit the whole book and write chapter three?" And so, one of the proudest achievements of my life came from, going. I just got super passionate, super focused on Buffett and Munger and value investing, and went the extra mile. It's really how I made a name for myself in the business. I was the guy who took the best, most comprehensive, and rapidly available notes on the Berkshire meeting and the Wesco meeting. So all the people in the world who weren't able to make the meeting in person were, I would spread my notes far and wide, and they would get passed around, and so I became, well known in this field because of all these initiatives that I just undertook because I was passionate about it and I wanted to give back to the community that had given me so much.
And this is exactly where I wanted to get into those 18 years of running Kase Capital that you had. I wanted to start with your research process. Where do you begin with? Did you run screens for low price earnings, low price to book ratios, or were you doing what Buffett did, which is like go through every single publicly listed business from A to Z? Were you looking for great businesses at reasonable prices or reasonable businesses at great prices?
Um, Well, you've asked two very different questions there, which is one, how do you source ideas? And then two, what were you looking for? What were your screens? And what style of investing was I? What ended up in my portfolio? So to answer the first question is I almost never use screens. It would just produce a list of 100 stocks. I knew nothing about it, whatever. Basically, I read widely and I cultivated a big network. And keep in mind, I started publishing on the Motley Fool website in late 99. I picked up a not full time, but a weekly writing gig in early 2000 as the internet bubble burst. I had done some guest columns preaching the gospel of value investing, telling people, don't get caught up. This internet thing is a big bubble. Listen to Buffett, buy Berkshire Hathaway, etc. And that's another important way I built my business because a lot of my readers, as the internet bubble blew up and everything I predicted came true, emailed me and said, "Hey, Whitney, would you manage some of my money? I understand you run a hedge fund." And I had good numbers and and so the same way I built my business is how I built my investing, which is I developed a network of super smart people. Like remember Mike Burry from The Big Short? He and I were emailing every day, swapping investment ideas. This is 5 to 7 years before he became famous for that big call. Now, some of my best friends to this day, my 8-year business partner, Glenn Tung, I met online in 1999. There was a little group of Buffett disciples here in New York that are some of my closest friends to this day. And so I started to develop some early email lists where I would just throw out ideas. Hey, I'm taking a look at McDonald's. What do you think of this stock? A group of us went up and visited a steel company. We hopped on a plane and flew up to Buffalo or Syracuse and went and visited a steel company called Universal Stainless and Alloy Products that a bunch of us invested in. So I basically was very early in the days of the internet where you could network people, and I would sort of crowdsource ideas from my readers, from my friends, and I would cherry pick the best ideas. And many of them, by the way, came from Bill Ackman. I was in McDonald's years before he was, and then the stock, I owned it from 16. I doubled down when the stock hit a 10-year low of like $12 a share. This was in March of 2003. And then I had a great ride up to about $35 a share. And I was thinking of exiting. This is now 2 years later by '05. And then Bill came along with his plan to break the company up. They didn't end up breaking it up, but McDonald's started doing a lot of the things he recommended. And I was like, oh, okay, instead of selling, I'm going to stick around. And I got another double out of it. I didn't end up selling till '08 when the stock was in the 60s. And I reallocated that money into beaten down stocks like Huntsman, CKE restaurants and things like that. I had a very eclectic portfolio. Fortunately, at the time, I was doing no shorting. I used no options. I wasn't out on margin. And by the way, I should have just kept doing that. I should have very simply just had a 10 stock portfolio and should have done that forever. That's a whole nother story that I write about in a book that I haven't yet published called The Rise and Fall of Kase Capital. But basically, I got too smart, and I discovered this cool thing called shorting and these cool things called options. And oh wait, my prime broker will let me invest $150 for every $100 of capital I have. I can go out on margin and make even bigger bets, all of which brought me to ruin eventually. Um, but at the time, in the early days, I didn't know anything better, and so everything was simple, and all I did is just try and find the 10 best stocks I could find out there. And generally, I was holding them for a reasonable period, multi-year period, ideally. And so, I got into McDonald's and Home Depot, and I always owned Berkshire in different sizes depending on its price, but ranging from 3% to 30%. But then I was into some smaller stuff. I would look for smaller, gems. A little air conditioning company called Aon, Aaon was the name of it. I was in that little steel company that grizzled veteran of the steel industry had bought out of bankruptcy. Called Universal Stainless and Alloy Products. USAP, ended up being a great stock. So I had sort of an eclectic mix. Later, sort of middle of that 18 years, I got into some Netflix when it got beaten down after I met Reed Hastings. So a lot of what interested me was when I had a relationship with somebody. Somebody introduced me to the company where I could get access to management that otherwise a small fund like me might not get access. So it was sort of eclectic. Again, in hindsight, if I were to do it again, I would, focus a lot more and all. But it was actually fairly effective by basically mining, creating this group of, I think, some of the world's smartest investors, and then just cherry picking their best ideas. I would always do my own work, but I would count on them to source ideas and give me very interesting, attractive situations from which I could then do my own work and pick and choose. So I guess that answers sort of both the source of ideas
Yes.
and the kind of things that ended up in my portfolio.
Yeah, it does. And I did want to get back to sort of the shorting mistakes and the portfolio management mistakes that you made later in Case Capital. But when you started out, and even today, which industries and sectors do you feel most comfortable analyzing?
Um, well, first of all, I think you have to decide, okay, am I going to be a global investor or am I going to pretty much stick to the US? For someone like you, if you were to go out there, I would suggest that you focus on India because that's where you grew up. It's a very large market, but it's a very undeveloped market, which leads me to believe that there are likely to be far more pricing inefficiencies over there. And particularly if you stay away from the top 10 or 50 companies that are owned by all the global investors, and instead go find, the next, go find the businesses like Aon or something like that are trading at 2 times earnings, and it's a family business, and you get to know the family because you speak the language and you're Indian, and you can go out and do boots on the ground like. I, of course, didn't have any kind of background like that. So, first and foremost, I decided to stick to what I know. Almost all my investing in my career has been in the US. But one of my big advantages was being small. So I was always looking for smaller companies. And then, for whatever reason, I got into a bunch of consumer retail restaurant stocks. I made a big bet in '03 when the entire restaurant sector got crushed, fast food in particular, because Burger King and McDonald's had a price war. And so I got into McDonald's, Yum Brands, Jack in the Box,
And Denny's as well, I think.
Denny's, and CKE restaurants. There were five that were 25% of my portfolio back then. And I am always drawn to whatever's bombed out. So I just finished writing our monthly letter to our lifetime partners this morning, and was talking about banks, the regional small and mid-sized banks. Whenever there's a lot of turmoil in a sector, the KBE, the regional banking ETFs, like down 37% this year, and it was down another 2.7% last month as the death throes of First Republic, sort of continue to roil the sector. And that's the kind of area where then I want to go look in that sector and look for the babies thrown out with the bathwater. There's not, I'm not finding a lot of, late last year, a lot of tech stuff got cheap, and I wrote about, the safest way to play it is just big cap tech stocks, and I listed 7 of them that are up an average of 50% since November when I wrote about them, versus like, I don't know, 7% for the S&P. But my pound the table stock was Facebook, Meta Platforms. And that's up 100% this year. It's up 150% or more since I really pounded the table in my free investing daily. I felt so strongly about it that I wrote 5 consecutive dailies laying out the entire thesis and why it remained one of the world's greatest businesses. And the stock was down 80% from its peak, and how cheap it was. And the beauty of it is much of what ailed the company was obviously short term and temporary. The rise of TikTok, Zuckerberg's idiotic infatuation with the metaverse. These were things that were either very clearly going to anniversary, like TikTok wasn't going to double in size again in a year, and or that were within the company's control. It's completely within Facebook's control to cut costs, to stop spending so much on the metaverse. Those are the kind of turnarounds you really want to focus on, where it's within where obviously whatever is plaguing the company is going to end once you sort of anniversary the impact, or even better, that it's within a company's control. So I would say I cast a pretty wide net. I read very broadly. I'm always trying to expand my circle of competence. Generally speaking, I avoid biotech and, cutting edge technology, and tend to stick to, pretty straightforward businesses that I can understand. And what I'm really looking for is having a variant perception where it's very clear to me what the market thinks and why the stock is priced where it is, and it's clear to me that the market is wrong, and I think something different. And so, for example, as a simple example, the banking sector today, rising interest rates have roiled the sector, and commercial real estate is going to be a problem in the sector, et cetera. But some banks saw this coming and positioned themselves well, and their stocks got out and whacked along with the rest of them. So there are well-positioned banks, and keep in mind, with rising interest rates, now banks can go out there and lend at much higher rates. This should be a tailwind for the sector once you get through the short-term issues. And so you got to find the banks that anticipated these short-term issues and are positioned to take advantage, because think about what's happening in the world right now is basically every single bank in America is pulling back on lending. Well, that means the banks that prepared can go out there and lend with a lot less competition. They can name their price for companies that need to borrow, right? So I think it's during times of turmoil in a sector, find the companies that are well positioned to benefit from that turmoil, so there's extra upside, and their stocks have gotten whacked along with the rest of the sector. So you get a win-win. That's where you get multi-bagger returns.
Mhm. Thanks for sharing that. You've mentioned in your book, Whitney, that the process of raising, when you were starting out and like in between, the process of raising money, marketing your fund really wasn't your thing, and you wanted to focus on like the research and investing part. I wonder how much of a distraction is the business of running a hedge fund, and how much did that interfere with you just doing research and being focused? And was your high profile and interactions with journalists also and the media also a distraction?
Um, yes, the short answer is yes. All of what you said is true. Um, I started out unknown and obscure, sitting in my bedroom, and I had no employees. Nobody called me. And I just cultivated a group of really smart people and did a lot of research and reading and was very patient and just built a very simple portfolio of 10 great stocks and generally very low turnover, maybe one or two trades a month. And then had I just kept on doing that, I'd still probably be doing it to this day, and my net worth would be 10 to 100 times what it is currently. Not that I'm crying poverty here, but so a variety of things happened. I call it the curse of success, and it's something everyone, every young person in particular, should be aware of, which is if you are successful, there will be so many things that distract you from the things that made you successful and can bring about, if not your ruin, because I did not experience ruin, but can really derail you for sure. So what are the curses of success? Well, first of all, when you become successful, you get promoted up into a senior position, let's say, if you're at a large organization, and or you become well known, and you start to hire people. Well, now, as your business grows and more people are reporting to you, your job becomes more managerial as opposed to just managing yourself and doing your own thing. Notice, by the way, how Warren Buffett has structured his life in a way that this did not happen to him. He has 14 people at the headquarters of one of the world's largest companies. And very importantly, he stayed in Omaha. Okay, he is not based in New York. So, in the investing business, you go from being an analyst and actually listening to the conference calls, going and meeting with management, going out and visiting stores in your early days, to becoming all your time is spent managing a much bigger portfolio and a whole lot of people. And so you're not out there doing the work. And so it's a credit to Buffett that he never allowed himself to become distracted in that way. It's a credit to Bill Ackman that I know personally because I spend time with him, and he still does the work. But in order to do that, he only owns 8 or 10 stocks, and he holds them for a long period of time such that he can still do the work. But that he's very rare. The vast majority of people who start managing billions of dollars or even tens of millions or hundreds of millions start to build a much bigger portfolio, and so they don't know each position nearly as well in each company. I started to certainly churn the portfolio more, so you're making a lot more investment decisions. You spend a lot, then you start hiring a lot of people, and you start spending time managing those people. And then, of course, young people like you come out of the woodwork, and I'm spending an hour and a half here talking to you. That did not happen in my early days. This is an hour and a half that I could, if I were running a hedge fund today, that I could have been, researching a stock, right? But I can't tell you both the joy and the benefits that have come to me from saying yes to grabbing a cup of coffee or doing an interview or a phone call with someone like yourself. I've made friends that way, and I feel good about it. It enriches my life. I meet interesting people. Young people like you a year from now sometimes come back to me and say, "Hey, Whitney, you ever looked at this stock?" Some of my best stock ideas have come from people who I took the time to have a coffee with, and I don't even remember them sometimes. Sometimes it's years later and I only met them for half an hour. But it's a time suck. It's a time suck. And at one point, I was enjoying it so much, meeting all these people and giving advice and helping other people out. Like that's the kind of person that I am. But I had it sucked up huge amounts of my time, and still to this day, I struggle with all the people who want advice via email, phone call, or worst of all, in person. When I say worst of all, I'm sort of saying it tongue in cheek, and that I really like meeting people in person, getting to know them, but it's much less efficient. It sucks up much more time. There is no such thing as a quick cup of coffee that takes 10 minutes. Anytime you meet someone in person, by the time I'm back at my desk or back to doing whatever I was doing, at the minimum an hour is gone, sometimes two. Right? So you get invited to every charity event. When you become successful and you have money, every politician, every charity starts knocking on your door, and all your friends start inviting you because they know you'll donate to their things. You invite them to your things. And then let's throw in your personal life as you go from your 20s to 30s. you're likely have gotten married. That sucks up a significant amount of time to spend with your spouse. It's a wonderful thing, but it is time you are not spending building your business or investing. And then the kids come along, and young kids are the most wonderful and joyous thing. I recommend them to everybody. My daughters are now in their 20s, and my wife did the lion's share of the child rearing. Thank goodness that she deserves all the credit for the spectacular young women that my 27, 24, and almost 21-year-old daughters are. But back in the day, when they were younger and lived at home and we weren't empty nesters, there was a 25-year period in my life where it was a significant amount of time. And then on top of it, I decided to build my business by being a high profile guy, by being on CNBC, going on 60 Minutes, doing interviews, the media stuff, building my business through being a high profile person. Was enormous amounts of fun. I loved the teaching that I was doing, that I can help other people discover Buffett and Munger and avoid the internet bubble and avoid the housing bubble. And I'm sort of proud of the track record out there. And I'll admit it was good for the ego as well. It's always sort of fun having a room full of people or a national audience full of people on CNBC or 60 Minutes, hanging on my every word. And it was critical to the way I built my business. But all of these things, you add all of them up, all of them were wonderful things. Everything I just listed is a wonderful thing, but every single one of them started to suck up large amounts of my time, and I got torn in a million different directions. I took my eye off the ball, and the stock market is a place where if you take your eye off the ball, it will punish you. So I think, there were some shifts in the marketplace and so forth. It was after the global financial crisis, the external environment became much less favorable to a long short value strategy, which is all I knew how to do. But I would say that's only 25% of the reason that I underperformed the market for 7 years and got frustrated and closed my fund in 2017. I'd say 75% of it is on me, that I let myself become distracted. I brought in a partner in part because I knew I was getting distracted. So I wanted a partner who wasn't distracted to help run the business. But that was a mistake. Money management does not lend itself to two people trying to do it together. So there were all these factors, but I'd say the reason, the title of my unpublished book, The Rise and Fall of Kase Capital, 12 great years, 10 and a half, 11 great years, and 7 years where I didn't blow up, but I underperformed the market. I would say those 7 years, 70% of it is on me, and 25% of it is the environment shifted from a tailwind to a headwind for long short value investing.
Right. You did mention, Whitney, that Buffett has sort of this advantage of being away from all the noise of New York City in a quiet Midwest suburb. Do
Hmm.
you think there is some kind of advantage of being away from all that noise? Your friend Guy Spear, he
Yeah.
was in New York City for 18 years and he left for Switzerland, I believe, to find a more tranquil environment where he can focus. Did being a hedge fund manager out of New York City add to the stress? And has the New York hedge fund life at any point, did it ever become shallow to you? Did it ever feel
Um,
shallow?
yeah, I think if I lived in Omaha, Zurich, or Southern California, where Monish Pabrai lives, for example. Um, or, my extended family has a house up in Lake Sunapee, New Hampshire. Had I been based out of there, um, there would have been significant downsides in terms of me building my network and relationships with people that led to raising money and to good investment ideas. But longer term, I probably would have been better off. And absolutely today, where the whole world is networked, everybody works remotely, where you've got Zoom calls like this, so it's possible to build relationships and networks without being in person now. Absolutely today, I would tell you to stay in Minneapolis. Well, let me rephrase that. I would tell you to get a job working at the best firm you can that can train you and can do it in person. Young people, this remote work that's now the work from home phenomenon and people only going into the office minimally, if at all, is absolutely fine for someone at in my stage of my career. I think it's a disaster for young people because the kind of mentoring that helps you build your career and builds your learning and all, I think happens in person. And so my advice to I would echo Scott Galloway's advice to young people: get credentialed and move to a city, whatever career you're in. Now, Minneapolis is a perfectly good size and city with lots of opportunities. So if you can find a great job there. But if you're interested in finance and money management, I'd suggest moving to New York and looking for a job here, just because this is the epicenter of the world's finance. And if someone's European, London, or I don't know, because of Brexit, I don't know if there's somewhere else in Europe. But the point is when you're young, but then when you're going to start your own business and so forth, being as remote as possible and insulating yourself. If you're not in the private equity or venture capital business where you got to go out and meet a lot of people and all, if you're just picking stocks, go as far away from civilization as possible, where there are few distractions as possible. But that's later in your career, is when you do that. When you're young, go where there's as much action and as much in person as possible, both for your career and also for your marriage prospects, which is the other. Those are the two, as Buffett says, the two most important decisions you make in your life are who you marry and what career you pick. Both of those things, your success in both of those areas, both making the right choice and having a lot of options to choose from to make the best choice, I think you're likely to find in a big city. But then later in life, go move to a log cabin with an internet connection. I've thought about my parents live in Kenya. They have a beach house down in Lamu which is an island off the coast of Kenya that has no cars. It's about as remote as can be. No one will ever come and want to have a meeting with you there. But they've now got decent internet, and I'm sort of thinking, heck, I could just go. Later this year, I may go to Africa for an entire month, traveling around southern Africa, and then going and hanging out at my parents' house in Lamu, and it won't affect what I do at all.
Thanks for sharing that advice you gave for us. I think that'll be really helpful to young listeners. I certainly enjoyed listening to that advice. Whitney, do you think one needs real entrepreneurial experience or business operations experience before they can be a good investor? Does one need to have experience of starting a business and dealing with its highs and lows, or work for a real business in order to be a good business analyst and a good equity analyst?
It helps for sure. That's why I suggest an MBA at a top school. My daughter's at Tuck up at Dartmouth, which is a great program. If you're going to go into finance or really want to start your own business and be a master of the universe, there's no place like Harvard Business School. That was perfect for Bill Ackman and me. My daughter did 4 years work as a consultant at EY Parthenon, Ernst& Young, one of the biggest companies in the world. Particularly for women working in a good sized company that has an HR department that's big enough. I've had many women friends whose careers have been derailed in the finance sector because it's still very much an old boys network. Same true, by the way, of sort of the tech startup world in Silicon Valley. Sadly, the two places in human history where the greatest fortunes have been made fastest by the youngest people are absolutely 100%, I would say 99% of the money, big money. If you add up all the money that's been made in the investment world and the tech world, 99% has been made by men. And as the father of three daughters, that saddens me. So I think my daughter made a very smart choice going to one of the world's largest firms. She had a great 4 years there, got promoted twice. They're paying her way through business school, and she owes them 2 years coming back. But I expect, my best guess is she'll stay there, become partner, and build a career at a large firm there. I mean, you don't need to go to Harvard Business School for that. Harvard Business School is for people who want to start their own thing and be entrepreneurial, and in particular in the world of finance. The hedge fund, private equity, and venture capital worlds are absolutely dominated by Harvard Business School alums. So remind me, I've gone down a little bit of sidetracked for what you're saying.
Yeah.
Remind me of your
It was,
question again.
did you need, yeah, did you
Oh yeah,
need
does
to
it?
have a
Yeah, does it help to have sort of business
yeah,
experience and all?
yeah,
So to answer that question, Buffett says, "I am a better investor because I am a business person. I am a better business person because I am an investor," and that is absolutely true. So I do suggest getting an MBA so that at least you get some broad business background. Don't kid yourself that if you work a bit in consulting, you work a bit in investment banking, that somehow you know shit as an investor or as a business person. You don't. And I don't think it's necessary. I know plenty of people who, if they're in the world of finance, they go do a 2-year program at Morgan Stanley or Goldman Sachs. They switch over to the buy side, maybe. They work at Blackstone. They go to Harvard Business School or Wharton or something, and then they come back and work for a hedge fund and all. And they can learn about a lot of different industries, all on the investment side and can build a lot of knowledge there. But getting some real world experience is always super useful. The best way to get a broad experience is at a top MBA program. So um, what I thought you were going to ask me actually is do you need to have entrepreneurial or operational experience to go out and start your own fund, as opposed to just working for somebody else? And that's a very interesting question. I should not have gone and started my own fund back when I did because I didn't lack the experience. But I now realize I should never run my own fund because I am an idea person. I went to a Tony Robbins things just to see what all the fuss was about this cult figure that many of my friends, swear by. And it was for business people. He does them a couple times a year for business people, for small business people. And it was in a Las Vegas thing with bright lights and music. And it was all very cult-like and all. I enjoyed it. It was a 4-day thing. I don't know, cost a few $1,000s. But the single biggest takeaway that made it all worthwhile is we had a little exercise. And he said, "Are you a managerial leader, an entrepreneur, or an artist?" And a managerial leader, as he defined it, was very simple. You run a division of a big company, or you run a big company, or something like that, right? That clearly wasn't me. It was obvious that I was an entrepreneur because that's what I'd spent for 30 years. The only real job I've ever had in my life was the 2 years at BCG right out of college before business school. Otherwise, I've just been working in my own home office or by myself or with a couple other people my entire career. And I don't have an artistic bone in my body. I couldn't paint anything, so obviously I'm not an artist. But then as I looked at it more closely, an artist here, the definition in the business context was someone who likes to read and think and come up with ideas, but is not good at administrative functions, hiring and managing people, raising money, dealing with compliance, et cetera, et cetera. And as I looked at it I was at this point 51 years old or something, and I realized, oh my God, I've totally misanalyzed myself. My entire career I have had a faulty understanding. I'm not an entrepreneur. I'm an artist. I'm an idea person. But anytime you get me into a position where I actually need to run something and manage people and all, I'm terrible at it. I don't like it. I'm terrible at it. And so that's one of the reasons why, having just closed my hedge fund, I realized that the opportunity to create an investment newsletter business in partnership with my old friend Porter Stansberry, who at the time was running Stansberry Research, which is now a public company under the name MarketWise, partnering with them to create an investment newsletter business made sense because they could handle all the administrative stuff. We didn't have to go out and raise money. They had the deep pockets. And I could just, bring in a couple of my friends from the hedge fund world, and I would be the public face of the business. I would do the writing. I was responsible for the investment ideas. So I could do all the things I was doing as a hedge fund manager that I loved to do, minus all the crap that I didn't like to do. And most importantly, the pressure of managing other people's money and having a bad month or year or multiple years that caused me so much stress. So My advice to young people who aspire to be the next Bill Ackman or even Whitney Tilson, I had a good 12-year run and made some nice money and had great fun, even though it didn't end the way I hoped. My advice is that 99% of investors should go work for somebody else in the same way that 99% of chefs should work in somebody else's restaurant, not try and start their own restaurant. It is starting your own fund is requires a completely different skill set than is required to be a good investor. It requires, by the way, most importantly, portfolio management skills, which I had never fully appreciated. Over a 10-year period, I would argue that stock picking is most important, but a very close second is portfolio management. How do you size positions? When do you get in? When do you sell? Do you use options? What's your total exposure, long versus short, et cetera? Do you have the patience and the wisdom to let your winners run versus get out of stocks before they collapse? Do you know when to double down on a stock that's gone down versus are you chasing something into oblivion? That the portfolio management side of investing, which is something that, if you're just an analyst at a big fund or a small fund, you don't have to think about that at all. All you have to do is go out and find a few good stock ideas a year. That's what I'm good at. I'm not good at portfolio management. I am not good at hiring managing people. I'm actually a pretty good salesperson in terms of raising money, but in terms of the process of raising money, I during my 12-year run, I shouldn't have gotten to 200 million. I should have gotten to a billion or more. I could have made retirement money during those 12 years had I had a proper process for raising money, had I built a structure and a team and been able to raise some institutional money and so forth. Ironically, I'm a great salesperson, but it was a miserable sales manager of that process. So you have to be able to do all of those things if you're going to start your own fund. The vast majority of people, if they're really passionate about investing, should find a nice home at a firm and just pursue their passion in the same way someone who just really loves to cook great food and be a professional chef should find a great restaurant and just work there and do what they love to do and let the owner of that restaurant deal with the real estate and the pricing and the unhappy customers and the hiring and firing of people and all the other brain damage that comes from running your own business.
Thanks a lot for sharing that, Whitney. And I also really appreciate you sharing what you enjoy about your investment newsletter business versus running a hedge fund, because that's a question I had for you. You have mentioned in our call right now that that one of the things towards like the end of Case Capital, you shouldn't have really shorted stocks as much, and you should have probably run a long only concentrated portfolio. Can you share with our listeners what Charlie Munger told you on the phone when you got into a little bit of legal trouble over your and Bill's MBIA short, and what did he learn from what he said?
Bill and I, this was back in the early 2000s. Bill had discovered MBIA, the bond insurer, as a short, and he was absolutely right. But MBIA was a big and powerful company, and Bill and I had sort of chimed in a little bit on it. So MBIA sicked the SEC and Elliot Spitzer, New York State Attorney General, on both of us, and they were both investigating Bill and me. We got these subpoenas, and it was a terrifying experience. I was running a little fund at the time, and I thought I was going to have to disclose all this to my investors, and it was going to bankrupt me, and I could go to jail and all of that. I could lose my business and or go to jail. So I called up Buffett to ask for his advice, and he said, if you haven't done anything, long and short of it is, he said, Whitney, there's if you haven't done anything wrong, then you have nothing to worry about. It's just a process, and this too shall pass. But he said, why don't you call Charlie? I'll bet he'd have some opinions. And I said, I'd met Buffett a couple times, but had never met Munger. And I said, Mr. Munger, would he even take my call? Does he even know who I am? And Buffett chuckled and said, oh yeah, he knows who you are, because keep in mind, I'd been coming and publishing the Berkshire meeting notes, the Wesco meeting notes, so I'd made a name for myself, including with Buffett and Munger. So I called him up, and the secretary put me right through, and hey, nice to meet you, etc. And he said, and I said, what advice for me do you have now that I'm getting investigated for, saying bad things about MBIA and all? And first of all, he said, Whitney, I'm familiar with your and Bill's analysis of MBIA, and it is undoubtedly correct. And then he snorted and he said, the idea that anyone would ever think MBIA is a AAA credit is ludicrous, he shouted into the phone. So I was feeling great. I was like, holy cow, Charlie Munger himself is telling me that MBIA is a bag of crap, like I think it is. And then he said, but Whitney, my advice to Whitney Tilson is don't go around shorting it, and don't go around saying bad things about MBIA, because he said, Whitney, if you go through life stepping on people's air hoses, they're going to hate you, and they're going to retaliate and attack you. And then he paused, and then he said, in my career, I shorted 3 stocks. And I forget what they were, but one of them, he said, I shorted the Japanese yen. So it wasn't a stock, but it was a short. And he said, of course, this was back in the 70s. And of course, I was right on it. But of course, it ran up against me and caused me lots of losses in the short term. And it caused me a lot of sleepless nights. And so my advice to you, Whitney, is just don't short. It's just, life's too short. It'll cause you a lot of brain damage, etc. And then he paused and he said, but you know what? Every young guy seems to have to learn this for himself. He was sort of saying it to me, but he was sort of saying it to himself. Like he knew I wasn't going to listen to him. This was the early days when I first discovered shorting. And I thought it was the coolest, most interesting thing, and finding these scummy companies and not only shorting them, but then using my public platform, using my writing, using my big email list to bring attention to the fact that there were these scummy companies and or overvalued stocks and all. And so I got drawn into it like a moth to the flame. For 15 years, I was shorting, and it sucked up huge amounts of time. I had some of my greatest wins, got me on 60 Minutes twice, made me famous for lumber liquidators and the housing crisis and all. But ultimately, it was a major contributor to my downfall. It was an enormous distraction and cost me a lot of money. And in particular, during the long bull market, where I just underperformed the market. For perspective, over a 5-year period, I think the market was up 96% and I was up 16%. Okay, so I didn't blow up. I made my investors money, and had the market really crapped out at any point in there, I would have done well because I had a big short book, I had a lot of cash, but I was just waiting for the next big downturn. So anytime I had a stock that went up, I sold it, and I was sitting on lots of cash, waiting for the next global financial crisis to come, and it never came. And so I was sailing in a sunny skies and calm seas, yet I had my ship's sails trimmed and was just basically sitting there, going forward at 1 mile an hour or something, while everybody else went racing by. And it got very frustrating, very demoralizing. And eventually I said, screw it, I could do something else. I don't feel like I can't figure out this market. Don't feel like I'm doing well by my investors. And after 7 years of that, I finally pulled the plug and gave my investors their money back.
Sure. So you did not end up listening to Charlie Munger's advice.
Oh, I did.
What?
I did 15
Okay.
years later.
Why do you think Bill Ackman that? Why do you think Bill Ackman still went ahead with the Herbalife short despite the legal brain damage from MBIA? And one of the things he said in another podcast is that what really kills investors is overconfidence. And Bill Ackman, and that strikes Bill Ackman is probably like that first person who comes to mind who makes these very, very high conviction, concentrated bets, which have been enormously successful, but at times quite disastrous as well. So, what would you say? What personality factors would you say Bill has that sort of leads him to go out and do that?
Um, Look, the dilemma of investing is The only people who do it, who get into it, you have to have a big ego. You have to believe that you're smarter than the herd, than every other investor and all their supercomputers combined, that are out there out there, that you're smarter than they are. So that is the mere act of buying any stock, much less starting your own business, starting a fund or whatever, is an act of arrogance, that you're smarter than everybody else put together. Um, on the other hand, to then be successful as an investor, you have to marry that confidence, even arrogance, with humility. And you have to be willing to say what Buffett says about, I don't know anything about cocoa beans. I don't know anything about Bitcoin and cryptos. And just sticking to, having the humility to avoid things, to say, I don't understand that. I'm the sucker at the poker table there. And or I was wrong, and exit a losing position. Humility of listening to disconfirming information, being willing to admit you're wrong, and or just don't know anything. Well, pretty much everybody in the investing world has all sorts of A and not much B. That was true of me. It's true of Bill. It's true of just about everybody. Buffett is a noteworthy example, a counterexample, where he has said, my idea of a group decision is looking in a mirror. He's got plenty of confidence, but he also has plenty of humility, and that's the key. That's the key. So this came to me with experience, and has, by the way, come to Bill with experience. He is now a much more humble investor than he once was, because he's been humbled, because I've been humbled. And actually, that makes me want to think he's a better investor. And for example, Pershing Square Holdings, this publicly traded vehicle, is an open recommendation in one of my newsletters. But I'm not sure I would have recommended, average American investors invest with Bill prior to Herbalife and then Valiant, humbling him back to back. But now he has given up shorting. He's never going to go into an area like pharmaceuticals and stuff that he really didn't know enough about. But he went in like he did with most of his investments, with all guns blazing. Didn't listen to all the smart people who were telling him, you're making a mistake here, just get out and move on, etc. And it cost him $1 billion on Herbalife. It cost him $4 billion on Valiant. Not that many people could recover from that, but to his credit, he has. His results have been exceptional, and he still has that confidence to make a big bet. For example, early in the days of the pandemic, where he made 100 times his money in 14 days, really. If you look at from when he finished buying those credit default swaps, anticipating the pandemic and the crash, to when he started exiting the position, he made 100 times money in 14 days. And then later, when he saw inflation starting to pick up, he made another big bet using derivatives that netted him $1 billion on that, less publicized, but enormously profitable bet there. So he's still, he has always been one of an absolute off the charts genius investor. But he's become an even better investor in his 50s because he's been humbled a couple times. And I think now has taken certain steps, like back in the early days, by the way, when his first fund, Pershing Square, not Pershing Square,
Gotham.
Gotham Partners, thank you. I'm having more of these senior moments in my old age. That's a whole nother discussion. Dementia. One of my greatest fears. When Gotham went under, part of the reason it went under is that he made a bunch of private investments that he put in a public hedge fund. And when he got a bunch of redemptions, he had no choice but to shut his fund. And he didn't blow up, but in order to be fair to all of his investors, he had to close his fund and then just distribute money pro rata, rather than selling all the liquid stuff and giving it to the redeeming investors and leaving all the remaining investors with a bunch of illiquid stuff that would take years to. It ultimately ended up taking years. So when he started his new fund, he vowed to never again do privates in his hedge fund. And he's unfortunately, to some extent, because, for example, he put $1 million into Coupang, the Amazon of South Korea, that turned into a 1,200 bagger, his $1 million Series A investment that he made personally turned into $1 billion too, which he then gave to his foundation. I'm on the board of his foundation. This is public information, I'm telling you. But he no longer puts privates in his public funds. Then after Herbalife, he has vowed that he is never going to be an activist short seller again. Uh, Too much, the return on brain damage just isn't there, and he learned his lesson. So as the Navy SEALs call them, these are lessons learned in blood. The first lesson cost him his business. The second lesson cost him $1 billion on Herbalife. But he's learned those lessons, and that makes him a much better investor. And that's why I think that's why I'm very confident recommending his publicly traded vehicle in one of my newsletters.
Sure. Thanks a lot for sharing that. As we close down on this conversation, Whitney, I really wanted to ask you some of my final questions on really your advice on relationships. You have a lot of different interests. You're very active outdoors. But one of the
Yeah.
things I wanted to ask you, Whitney, is that you have this uh, you have this childhood of being scrappy and being exposed to the hardships of the world, especially in Tanzania and Nicaragua. And you said you're very proud of the way your daughters have turned out. They're all thriving and resilient. But as a parent, did you worry that because you were already wealthy when they were young and they all went to private school, that they will not be able to handle the adversities or shocks of life, or they won't be able to squeeze that last dollar until it screams? Given that I grew up in Dubai, and growing up in Dubai is not real life, my parents really worried about me whether I would be able to handle the shocks of life. And I hope I've proved them wrong after coming to the United States. But I wonder whether you worried the same for your kids, given that they grew up comfortably and you were wealthy, and probably what you did, what action steps you took.
Yeah. Well, there are two things that were very important to me. One is resilience, and the other is gratitude. And they're quite different, but they're both major issues of children who grow up in 1% households. My understanding is that the census tract I'm sitting in right now, the Upper East Side of New York, is the wealthiest census tract in the United States. It So my children grew up amidst great privilege. And it's funny, they don't think we're rich because they hang out with Bill Ackman's kids and David Einhorn's kids. We don't have a huge home in the Hamptons and don't have a private jet. So it's sort of funny, but just for that environment. But let me tell you, the amount of young children of wealthy people who are suffering from anxiety and depression, drug use, and the single biggest one among girls is eating disorders, anorexia, and all. It is an absolute epidemic, everything I just mentioned. I can't tell you the number of close friends I have who are distraught. They have all the money in the world and they cannot help. They don't know what to do other than, hire the very best doctors in the world who struggle with, a 14-year-old or a 16-year-old who has threatened suicide or who is wasting away due to anorexia. Um, so, uh, so, so how did and the other thing that was very important to me is that my daughters, despite unlike me having seen it in person growing up, the poverty around the world, and you just develop. I did not grow up with any hardship whatsoever. My parents, while middle class, sacrificed everything for my sister and me, always we were a super tight knit family. We never wanted for anything, though we never went out to dinner. Like going to Friendly's once a month when we lived in Western Massachusetts was the absolute biggest treat ever. To go have a fribble and a cheeseburger, to go out to a fast food restaurant was an enormous treat. We only wore secondhand clothes basically, but we always traveled like crazy. In our Volkswagen minibus that's got hundreds of thousands of miles, we still own it to this day. What we call the green bean, the green Volkswagen camper with the little pop top like that, where my sister and I slept up top. My parents slept down below, and we traveled across the country. So, it was, we were very frugal, but my sister and I never wanted for anything. And my parents, when we lived in Western Mass, starting in seventh grade, after sixth grade at a public school, that was the last year I ever went to public school. The local junior high and high school in Western Mass was not a college preparatory school. And so my parents really sacrificed, and I got a scholarship because they didn't have a high incomes working at the prep school, Northfield Mount Hermon. Sent me to Eagle Brook, a very elite private school that was about 45 minutes away, right up the hill from Deerfield, the prep school that many people know. And so I went to Eagle Brook 7th and 8th grade, and then I went for free to Northfield Mount Hermon. And my sister went for free there as well. One of the reasons my parents worked at this school and weren't over in third world countries doing their thing, which is what they did the entire rest of their careers, both before and after Northfield Mount Hermon, is because of the perk of the job that they had kids who could take advantage of 4 years of an outstanding prep school education at Northfield Mount Hermon, which is what accelerated my sister and me to Harvard and Stanford, respectively, and into successful lives. So my children did not grow up with any of that. They started in private schools. They've never set foot in a public school in their lives, basically, certainly not as students, and have grown up in this privilege. And so we travel with them a lot. We've taken them to Africa many times. My parents lived in Ethiopia before Kenya, and so we took them to Ethiopia, which is much poorer than Kenya. And so I was talking with my youngest daughter, who's about to turn 21, and I said, I keep track of how many countries I've visited in my life, and I'm up to 77. And I asked Catherine, how many she's up to, and she keeps track, and I forget the number, but something like 32 or 34. How many 20-year-olds have been to 34 countries, right? So my daughters have seen the world not just from five-star hotels, but we like to do backroads trips where we're biking and hiking, very active trips, and they've been to Africa many, many times, and into poorer parts of the world as well. So always teaching them gratitude by our travel and by our example has been critical. And then the other piece of that, resilience and self-confidence and all, because I really do think a lot of the anxiety, depression, eating disorders and all that I see among teenagers is rooted in just a pampered life where they've never had to deal with any adversity or whatever. So I was determined to have outdoor kids. I was always an outdoor kid. I never ever recall playing indoors with my friends. We were always outdoors. And so whenever I got the opportunity, particularly every weekend, I was more the weekend dad because I was traveling during the week or working real hard. So, but every weekend, all day Saturday, all day Sunday, the kids were mine, and I'd take them, and we lived right near Central Park, and I'd take them out into the park, and we would hit every playground, every merry-go-round, swings. I'd bring out soccer balls, and it was totally active. And I would push them. And so even when they were very little, I would have them climb up the big, tall, 8-foot tall slides. And then they'd be up there to go down this big, fast slide, and they'd be sort of scared. And we're talking age 2, maybe 18 months. And I would be like, okay, go down. They'd start crying and be all afraid. And I was like, well, go down or I'm going to push you. And so at some point, I think some people would say it bordered on cruelty, but I was never actually endangering them, but I was forcing them outside of their comfort zone. And I was training them to be athletic. And there's a lot of evidence that girls, when they hit their teens, which is right when they start to lose self-confidence, anxiety, depression, eating disorders, cutting, drug use, promiscuity, all the things that can sink girls happen right when they become teenagers and hit puberty. And all the pressures and judgment from the world and this about beauty and perfection, etc. Then throw in living on the Upper East Side of New York on top of that. And you can see why so many kids, particularly teenage girls, in this environment go off the rails. But I felt very strongly that if my daughters were all very athletic and played varsity sports in high school, but just had very strong bodies, were strong physically, and confident in their athletic abilities, and that would translate into them being much stronger mentally, much less likely to fall prey to these things that have derailed so many of their peers. So I ended up, by the way, I know you're referring to, I'll just hold up a picture of my book that I wrote. Um, This is called The Art of Playing Defense. And it was a book I wrote for my daughters, and it's available on Amazon. I narrate it if you want to listen to it on Audible, and it's my best advice on how to lead a successful life, but rooted in a Charlie Munger, where he says invert, always invert. If you want to have a successful life, avoid the things that will make you unsuccessful, that will bring you to ruin. So the book is structured around the 5 calamities that can ruin your life and how to avoid them. And one of them is ruptured relationships, loneliness, ruptured relationships. That starts with your spouse. So I've got a big section on how to marry the right person, the 12 questions to ask before you marry someone. And then once you've hopefully married a good person, how not to let that marriage go south. But it also, I've got some stuff in there about second most importantly, after your spouse, is your children and having good relationships with your children. And sort of in there, I've got some of my advice on, raising strong, resilient girls, which my wife and I have.
Thanks a lot for sharing that. And I think Buffett also said something similar where like you don't have to do too many things right in your life as long as you don't do too many wrong. And
Yeah, that's a
my
theme of their
parents,
investing and living.
yeah, and my parents, I went to a private school as well because my dad's employer was paying for my sisters and my tuition, K through 12. And I would say I went to a school with kids much richer than their families were much richer than mine. And I remember early in middle school, I'd feel that, these guys, they have fancy bags, fancy shoes, they have a PlayStation. I don't have these things. But one of the things my parents instilled in me is just be independent and always live beneath your means, and you should never care. You should, you know eat the best food, make sure you wear good clothes, but you always make sure that you're spending below your means and never compare what you have to someone else. And we were fortunately, of course, way much better compared to millions of people and billions of people in the world, and definitely in the sort of upper middle class strata in India. So my parents instill a deep sense of gratitude in my sister and myself as well. So I have two more questions for you, Whitney, before I close on you. In your book, The Art of Playing Defense, you have written about the importance of making very important decisions when you're in the right frame of mind and when you're in a good place emotionally. What habits or routines do you run to make sure you're in the right place mentally? And I'd be grateful if you could share an example of that, maybe in an investment or portfolio management context, and maybe even in your personal life.
Yeah, well, look, there's a lot of research around decision making and all, and people, when they are obviously under the influence of any kind of drug or alcohol, obviously, but maybe less obviously when you're under a lot of pressure, either short term or just long term pressure, or stress, financial pressure, mental stress. I have seen people, I fortunately, knock on wood, will never experience what happens when you're going through a divorce, and how one of my friends once said, oh, if he invested in a lot of different hedge funds, and he said, if a manager's going through a divorce, I immediately redeem. And I used to think, wow, that seems like an awfully harsh absolutist rule, and you'd think a good money manager and all, but I now actually believe it. The divorce is so time consuming, mentally, emotionally. It can go on for years, and it puts even a wealthy person under enormous financial pressure. And I absolutely see it manifested in poor investment performance. A very important element is just getting enough sleep. I used to feel guilty getting 7 hours sleep a night. Now I'm almost religious about getting 8 hours sleep every night. Maybe not as important when you're your age, but definitely more important the older you get, the more important it is to get a really good night's sleep consistently. And so there's a great TED talk by a guy named Matthew Walker. He wrote a book, I think it's called Why We Sleep, something like that. Just do Matthew, if you just Google Matthew Walker sleep, you'll find it on YouTube, and you'll find his book on Amazon. And it really changed my life in many ways, feeling guilty about 7 hours to demanding 8 hours. So that's an important element as well. So I'm not sure I can give you a concrete example of like an exact investment decision I made. I do like a stock or something. I do recall there was a period of time after I closed my hedge fund where I was teaching investing seminars. And I had just launched the first seminar. I was teaching it by myself, and I had a dozen students who'd given up a week and paid $5,000 each to come learn from me. And I was up all, half the night every night preparing my teaching materials for the next day based on what had happened the first day, the previous day. And I was extremely energized, but also sleep deprived. And I now look back, and it's what my shrink calls a hypomanic episode. So I didn't have a manic episode. I'm not bipolar, but there are every few years, I go through a very intense period, personally or professionally, where sometimes it's a very good thing, like recently when I was going to Ukraine and getting very involved in raising money for Ukraine and delivering ambulances there. And I've been to Ukraine twice in the last 2 months and all. I went through a similar episode, and I can always tell. It's very easy to tell because my sleep is disrupted, because my mind is racing. Well, back when this was late 2017, after I'd closed my hedge fund, I went through one of these episodes, and I didn't manage it well. And I had a 21-day period where I got 2 to 4 hours sleep every night, when normally I get, at the time, probably 7, now 8. And it was like I was almost in a drunken state. I look back and I was not thinking clearly. There's lots of research that shows even if you should never pull an all-nighter studying for a test, because you will do worse on that test than any benefit from the extra hours of studying. Just one night of sleep deprivation is the mental equivalent in terms of any way you want to measure your brain's performance to, one or two drinks, maybe not legally drunk after one all-nighter, but I've done all-nighters running races and ultra marathon stuff like that. And so it's definitely true. So an extended period of sleep deprivation has all sorts of bad health consequences. But in this particular case, in late 2017, I became drunk, almost like drunken, but also sort of giddy and overly optimistic. And I thought this seminar business was going to, grow and grow and grow. And so I hired a bunch of people and committed to a bunch of expenses during this period, which ended up the business did not grow and grow like I had wildly overestimated during this period. And I ended up losing something like $750,000 starting up this new business, because I had built out an expense structure of $1.5 million, expecting to have revenues of, well above that. And instead, revenues came in at 750, and I had a $1.5 million expense structure. And so it cost me 750 grand before I recognized the mistake and pulled the plug, and eventually, cut the costs and eventually shuttered the business. But that's a very concrete, tangible example of how I made a business decision when I was not in my full, healthy mind that cost me dearly.
Last two, firstly, thanks a lot for sharing that personal example, Whitney. Last two questions for you. Given that you're always learning and doing something new, what are some deep passions and hobbies you have now, but you develop later in life?
Well, I've always been involved in various philanthropies, depending on the environment and the fundraising environment and sort of what's happening. So in the past year, I've been very involved in Ukraine. A couple years before that, very involved in criminal justice reform. For 30 years now, since I helped start Teach for America, I've been very involved in charter schools and education reform. I'm involved in a number of charities over in Africa that I've, in many ways connected with through my parents living in Ethiopia and then Kenya. I'm also very involved politically, support a lot of different political campaigns and candidates and issues. So I'm very passionate about sort of adventure sports. I'm over the top in terms of travel. Like during COVID, as the rest of the world was shut down, I went to 15 countries. just traveled like a maniac. I'm sort of in a down period right now. Like in an off month for me, I do a 3-day weekend in Omaha and a 4-day weekend in Rome, going to the Italian Open tennis tournament. That's this month. That's the least active month I can remember. From December through March, I went to Fiji on a scuba diving trip, Antarctica on a trip with my family, went to Las Vegas, went on 5 ski trips, went to Switzerland, Las Vegas, Orlando, Deer Valley, Snowbird, Jackson Hole, and the Dominican Republic. And on top of that, went to Ukraine twice and Poland 3 times. So, um, so that I do because I love to travel, and a lot of my travel relates to spending time with friends and family, and or doing good in the world. So I marry my passion for travel with all of those other things.
Thanks for sharing that with me. The very last question. What is the kindest thing someone has done for you?
Hmm, hmm.
Maybe it could be at any stage. It could be maybe when you were earlier stage of your life, college years, early in your career. What would you say is
Good
one
question.
gesture that someone had done to you earlier in your life that you've remembered all these years?
Hmm, I'm having trouble thinking of one. Of the 12 questions to ask before you marry someone that's in my book, the first question is that you should ask of someone you're considering marrying is, are they a kind and good-hearted person? And then there's some related questions, all one question. Do dogs and children like them? How do they treat people beneath them, like the Uber driver or the server at the restaurant or a household help or something like that? Right? Because someone who's not really, I've had friends who've gotten married to mean people, and it's been a disaster. Um, and but they fooled them because they didn't come across as mean, because when during the throes of passion and falling in love and so forth, they're on their best behavior. But at their core, they're a mean person, right? You want to avoid that like the plague, right? So, kindness is the single most important attribute I recommend that someone look for in a spouse. Certainly, what I looked for and found in my spouse, and I try to model that. And it goes back to, I guess, in many ways, what Buffett talks about. The One of the most impactful things he ever said that's really affected my life is the chains of habit are too light to be felt until they are too heavy to be broken. And by that he means it's the little day-to-day things, your habits, that in any one given day are almost irrelevant. Whether you are kind and how you treat somebody else, to whether you do some exercise or not, what you eat, whether you get a good night's sleep or not. Those 4 things that get to relationships, exercise, diet, and sleep. I just finished a book called Outlive by Dr. Peter Attia that everybody's been recommending. It's a best-selling book and all. And those 4 things are the things that determine how long you're going to live from a health perspective. He's approaching it from a medical perspective, but I would also argue that will determine those things will determine your long-term happiness in life. Those are all things I talk about in my book. And maybe the reason I'm having trouble thinking of any one thing is because my life is an accumulation of thousands of acts of kindness by me toward others, um, and then it of course is reciprocated by others toward me. My parents, their whole lives have sacrificed everything for my sister and me, and I don't know whether that's kindness or parental obligation. But all of my friends and my wife, my children, etc. People have done so many things that that's why I consider myself the luckiest guy in the world. In part, it not just because I've had good health and a reasonably successful career and so forth, but because I'm surrounded by wonderful people who are kind to me. And so I don't know. I'm sure as soon as we get off this call, I'll think of a great answer about one thing, but I think it's actually much, much, much more important rather than thinking about one, over the top act of kindness to instead, the real way to think about it is you've identified correctly, I think, certainly one of the absolute most important things in life that will determine your long-term happiness and success. Because it, by the way, completely affects your professional career if people view you as a kind and good-hearted person. This idea in the professional world that you have to be a bastard and backstab your way and climb over others to get to the top is absolute nonsense. The people by and large who make it to the top are people like Buffett, who took that phone call from me when I was feeling down and all, and then Munger took the phone call as well and spent some of their time giving me some advice, but also some sympathy. And, when I was feeling like, my life is over, my career is over, I could go to jail or whatever, those were real acts of kindness. But, they don't really stand out because my whole life is filled with people doing kind things to me like that. But that's because I spend my whole life, giving the same way.
Yeah, thanks for sharing that. I think that's a
Yeah.
great answer. Like those small acts of kindness sort of accumulate over time and they come back to you. Finally, Whitney, where
Mhm.
can people learn more about Empire Financial Research, case learning, and about yourself?
Yeah, well, there is no case learning anymore, but Empire Financial Research is just go to empirefinancialresearch.com. Every day I publish a free daily that goes out to about 120,000 people. It's my views on the markets and interesting stocks and what's going on in the finance world broadly. But every one of my emails has at the end of it, it's something personal. Hey, greetings from Fiji, wherever I'm traveling to. I write about and include some pictures. I include excerpts from my book about raising kids. It's funny. I run. I'm very active athletically, and I belong to a running group. I've had some injury, a little plantar fasciitis in my left heel. So on Friday, I tried out some new running shoes that made an enormous difference. I ran much faster using the new Nike running shoes as opposed to my old Hokas. So I wrote that up. Then, what does that have to do with investing? It doesn't have anything to do with investing. It's just my attempt to personalize my investing email and to share not only, there's so much free content out there in the investing world that I try and differentiate myself by sort of having opinions, having a personality, and sharing personal stuff as well. So the best way to learn about me and follow me is go to empirefinancialresearch.com and just enter your email address and get my free daily. And you can buy my book on Amazon, The Art of Playing Defense, as well. I've written some other investing related books, but I actually would suggest that people start with The Art of Playing Defense.
Whitney, it has been a true pleasure and true privilege to have you. I know how incredibly busy you are, especially leading up to the week. This week is the shareholders meeting, Berkshire shareholder AGM. So I'm sure you're really busy prepping for that. So thank you so much for giving your valuable time. I'm sure a lot of the insights you've shared today are going to be really helpful for our young listeners and also our middle-aged listeners. We've covered topics from right from the days you started in the investment business to a lot of your interests today to a lot of life advice. So thank you again for your time. It means a lot.
Yeah, my pleasure. And if any of your listeners or viewers are going to be out in Omaha for the Berkshire meeting, one, it's not too late. Highly recommend it. To get a ticket, all you have to do is go buy one Berkshire B share and bring a brokerage statement, and they'll let you in. You are a shareholder at that point. And everyone has extra tickets anyway, but I'll be hanging out at the bar at the Hilton, right across the street from the convention center. In past years, I've hosted like a big event. This year, that got too expensive and too much of a carnival. So I'm just going to hang out at the bar at the Hilton Friday and Saturday evenings. And anyone who wants to come meet and chat in person, please stop by.
Sure. Thank you so much, Whitney.
All right.